throughout. Stephen Poloz was Canada's 9th central bank governor and still at the helm until June of this year, through the beginning of that very important period of the pandemic. I talked to Poloz earlier for a Bloomberg Live event, the Canadian Fixed Income Conference, and I asked him about some of the most important lessons that he has learned in the past 6 months.
First thing, right in the heat of the moment, was that central banks can do quite a lot to avoid financial crises. Most central banks acted very quickly with force. If you compare that back to 2008, it was much faster this time. Back in 2008, it was a little bit more sequential, kind of learning by doing. And so that allowed some of the stresses to build. And this time, I think it was pretty well preempted. And the second thing is that because we started all this close to the lower bound of interest rates, we knew all along that fiscal policy was going to be needed. But we also think of that in a technical way. And when it comes to the actual execution, politics really matters. Fiscal policy was never built for speed, for sure, but politics can keep your car in the shop for a very long time while it gets negotiated or debated or what have you. And so I think the lesson of that is it's better for us to develop more enhanced, stronger, automatic fiscal tools so that they work without the debate. But bottom line for all that is good fiscal policy can avoid the need for negative interest rates, which I think is a good thing for everybody.
Well, let's get to that. Action was taken. It was necessary. It was, to your point, fast and unquestioned. You were talking about the need for fiscal policy before March 2020. You were talking about this months and months and months before that. Fiscal needs to step up. So is monetary policy, is there a limit to what it can do?
Well, there is, and we're very close to it. And what we were arguing before the crisis, before COVID came along, was that actually there's a whole second layer to policy discussions, which is the mix between fiscal and monetary policy. If you have a prolonged kind of soft patch for the economy, if fiscal policy does more of the work of giving the economy a lift, it takes some of the burden off monetary policy, and you can therefore have, on average, a higher rate of interest in the economy, which of course cuts off some of those stresses that we pick up, financial strains, bubbles, if you like, too hot of a housing market, those kinds of things. So the mix of policies can matter quite a lot all the time, not just during a crisis. And so I think that was the nature of the discussion there. Of course, it's doubled now, where we have monetary policy basically has done most of what it can deliver. We know there are other tools in the toolkit. Those tools deliver things. We've had experience with negative interest rates, for instance, and lots of QE. But really, all you're doing there is you're trying to squeeze a little more juice out of the lemon. You've done most of what you can do already. And so really, in this stage, fiscal policy is the primary tool. And that's not a new thing. Keynes wrote that in the 1930s, right? It's not some big insight.
I mean, what may be new, and still one could argue an experiment that's unfolding in real time, is this amount of stimulus on the monetary side, 10 plus years of stimulus on the monetary side with fiscal consequences. Fiscal policies have monetary policy consequences. Do you think there will be results here that could be negative in a way that we either haven't foreseen or that we're not prepared for?
Well, there are some basic things there that we need to keep in mind. First of all, monetary policy looks incredibly aggressive in this situation, but I think that only matches the profound nature of the crater that's in front of us in the economy. So if you're a major company under stress, and you've got credit lines with several important banks, your board was screaming at you in March and April to draw those credit lines, get the cash in the door so that we've got room to maneuver. Well, that influx of cash is like a precautionary demand for credit. And that demand is satisfied usually not through the system, because the system was pretty tight, kind of gummed up, as you know. So central banks are there doing repos and other transactions with banks in effect providing that credit down through the pipelines. So that extra demand for cash is still there, it's still being satisfied. But as the economy goes back to a more normal setting, that angst will go down and that money will come back through the system. Central bank balance sheets will shrink automatically. So a lot of that has a highly temporary nature to it. The QE, that's another matter. So QE is another matter where you're accumulating that large balance sheet. But in theory, that balance sheet can be any size as long as there is a corresponding element on the other side, government working balances, et cetera. And so the real question we have is sustainability of the fundamental debt that's being drawn down by governments. And that, of course, is something we have to understand better. We could be well over 100% of GDP by the end of next year, according to the IMF this morning. That's what they're monitoring for the major economies. Well, those are big numbers. We're just not experienced with that. And so, provided the interest rates stay low, and it looks like they probably would, it's more of a debt service issue, just like it is with a household. So in the end, I think a sustainability criterion can be met, provided that the government money is being used for productive reasons.
But the $64 trillion question for both government and for homeowners is, will interest rates stay low? And obviously, we've experienced very low sustained rates. And unfortunately, you can argue we now have a generation of both politicians and homeowners who know nothing else. They know declining rates, really, as a state of being. They don't know rising rates or rates beyond the bank's control. Every time a journalist raises this question, you get kind of batted down as it's nothing to worry about. It seems to me, given what you just said, that it's something to worry about.
Yes, I think it's something we need to be investing lots of brain power into. And some of the old adages won't go away. But I think that interest rates, in real terms, interest rates are likely to stay low for probably a generation. This is basically a demographic effect. If you look at a 150-year chart on interest rates have been low almost forever, except in the 70s, and the 60s, 70s, and 80s. And that's primarily the demographic boom that we had post-war. That drove higher growth rates and higher demand for savings. But if we look, the rest of the time they've been low. And I expect, because demographics are still slowing throughout the world, interest rates will stay low. But really what matters for debt service is the nominal rate of interest. And that, of course, brings us to what's the outlook for inflation? Because if inflation picks back up, then interest rates are going to pick back up. And so that hinges, of course, on demand and supply in the economy. Right now, we're very preoccupied with deflation risk, and as rightly so. But looking farther down the road, that hinges more on the question of the credibility of central banks, fiscal dominance, if that becomes an important factor, political interference with the inflation process. In addition, we have a number of things that are coming into the system that are more cost push. And so income supports, green taxation, those kinds of moves, deglobalization, those can all add to inflation at this stage of the cycle.